David, good to have you here to weigh in. Put this in context for us, and we've been discussing what it might mean, what it doesn't mean, but also it's coming at a time when markets are digesting what the Bank of Japan did or didn't do last week, and yields have been moving higher in general.
Yeah, Mike, I think you summed it up very well in your initial take here. There's a lot going on that is affecting the long end of the bond market, and that in turn is affecting people's thoughts on valuation in stocks. I think what the BOJ did last week is still being digested. We've seen a very significant rise in long-term yields in Japan. People are reassessing what they think the buying out of Japan, one of the largest buyers of foreign securities in the fixed income markets, what that will be coming out of the next couple quarters, if not longer. So these are big moves and big changes as we move toward a 1% yield target in the JGB market or in the 10-year JGB market. And then, of course, you have the data today. The ADP data was strong. The data we've had pretty much across the board has been strong. We've seen good data in GDP. We've seen weaker inflation, but we've seen good news data all around. And I think that's, that's going to keep people's thoughts that the Fed is going to keep pressure up here for a while. And remember, Mike, we have 120 basis points of rate cuts priced into the market for 2024. That is a lot of rate cuts. And that is what's priced into the stock market as well. And if we start to maneuver some of that out over time and re-steepen out that part of the yield curve, that part of the money market curve, or the projection of where money market rates are going to be, I think it's going to weigh on stocks. It's going to steepen the curve out a little bit, and it's going to be kind of a little simpatico with what we're seeing today in markets.
Yeah, certainly a fair point that that the market has had to continually move out its forecast of when the Fed might be cutting and how long rates might stay up here. But can we really isolate how much of those projected cuts in short-term rates is in the stock market as opposed to the bond market? Because, there wasn't that long ago where the market was projecting cuts for the latter part of this year, and stocks were a lot lower before those were priced out.
Right, and if you keep rolling them out and you keep the 10-year yield kind of in and around whatever, 375 to 4.25, the stock market's going to be just fine with that because the stock market's really focusing on that long-term point. But, if we start to really push 10-year yields up to the top of the range, 4.25 or higher, I think that's where you can get a little bit of an issue with people thinking about valuation slightly differently. Right now, the market, whether they start easing back or taking their foot off the brake, if you will, a couple of quarters earlier or a couple of quarters later isn't going to matter as much for the stock market. It is going to look really to the longer term structure. But if we're longer, if we're at these higher yields for longer or on a more permanent basis and we're staying at higher levels than people thought, I think that's going to have to weigh a little bit. And it's one of the reasons why I think stocks get a little tricky as we go into the end of this year. We got a heck of a run, and I think you've got a lot of easier ways to skin the return cat by looking at those higher yield credit sectors of the market, particularly in leveraged loans where you're offered a short rate instead of a long rate, but even the high yield bonds.